Question 1. Which of the following statements best describes the regulatory nature of an insurance contract? A. The insurer guarantees to pay a specific amount of benefits regardless of the premium amount paid. B. The insurer's obligation to pay benefits is dependent on an uncertain event and the amount paid may be disproportionate to the premiums collected. C. The contract is based on mutual agreement and consideration between the insurer and the insured. D. The contract can be cancelled at any time without any penalties if the parties agree. Answer. B. The insurer's obligation to pay benefits is dependent on an uncertain event and the amount paid may be disproportionate to the premiums collected. Explanation. The term regulatory refers to the nature of insurance contracts in which the outcome is contingent on an uncertain event. In insurance, the insured pays premiums and the insurer provides a benefit if a specific event occurs, such as a claim. The benefit paid can be far greater. The premiums paid, e.g. in the case of a large claim, or the insured may pay premiums for many years and never receive a payout. This inherent uncertainty and unequal exchange define the regulatory nature of insurance contracts. Options A, C, and D are incorrect because they either misunderstand or mischaracterize the unequal exchange and conditional nature of insurance contracts. Question 2. John, a 45-year-old man with a history of heart disease, applies for life insurance coverage. After submitting his application, the insurer reviews his medical records and determines that his risk of premature death is higher than average due to his health condition. Based on this, the insurer decides to offer him a policy with an exclusion for heart-related issues, but the premiums are higher than usual. What aspect of underwriting does this scenario demonstrate? A. Preferred risk classification. B. Substandard risk classification. C. Standard risk classification. D. Policy replacement rule. Answer. B. Substandard risk classification. Explanation. In underwriting, substandard risk classification refers to a situation where the applicant presents a higher than average risk to the insurer due to factors like health conditions, occupation, or lifestyle choices. In this case, John's heart disease increases his risk, leading the insurer to offer him coverage with higher premiums and an exclusion for heart-related issues. This reflects a substandard where the insurer adjusts the terms of the policy to account for the higher risk. Option A, preferred risk, would apply if the applicant had a lower than average risk, while C, standard risk, would apply if the applicant had average risk. Option D is unrelated as it pertains to policy replacement regulations. Question 3. Which of the following factors is most likely to be used when determining an individual's health insurance premium rates? A. Marital status. B. Credit history. C. Occupation. D. Risk classification. Answer. D. Risk classification. Explanation. Risk classification is a key factor used by insurers to determine premiums. This classification considers the applicant's health, occupation, hobbies, lifestyle, and other personal characteristics that may influence the likelihood of a claim. Risk classification helps insurers assess the overall risk of providing coverage and set premiums accordingly. Marital status and occupation may indirectly premiums, but they are not the primary determinants. Credit history is sometimes used in underwriting, especially for other types of insurance like auto or property, but it is not a primary factor in setting health insurance premiums. Question 4. Which of the following is an example of a non-forfeiture option in a life insurance policy? A. Waiver of premium. B. Accelerated death benefit. C. Reduced paid-up insurance. D. Accidental death benefit. Answer. C. Reduced paid-up insurance. Explanation. Non-forfeiture options allow the policyholder to avoid losing all benefits if they stop paying premiums. Reduced paid-up insurance is one of the non-forfeiture options where the policyholder can choose to reduce the death benefit in exchange for keeping the policy in force with no further premium payments required. Other options like waiver of premium, accelerated death benefit, and an accidental death benefit are not non-forfeiture options. The waiver of premium is a rider that waives premiums under certain conditions, while the accelerated death benefit and accidental death benefit are riders that provide additional coverage or benefits under specific circumstances but do not allow the policyholder to keep their policy without paying premiums. Question 5. Which of the following is considered a hazard in the context of insurance underwriting? A. The use of seatbelts in cars. B. A person's high-risk occupation such as mining. C. Person's physical health condition. D. Car safety features. Answer. B. The person's high-risk occupation such as mining. Explanation: in insurance, hazard refers to condition or situation that increases the likelihood of loss occurring. High-risk occupations such as mining is an example of hazard because it increases the chance of injury or death, thereby raising the insurer's exposure to loss. While physical health and seat belts may affect risk, they are not classified as hazards in the insurance sense. Person's health would be risk factor, and car safety features can affect the severity of claim but do not qualify as hazards. Question 6. Sarah, a 32-year-old female, has just applied for a term life insurance policy. During the underwriting process, the insurer uses automated underwriting systems to assess her risk based on data inputs like her age, gender, health, and lifestyle habits. Which of the following is most likely being assessed in Sarah's underwriting process? A. A subjective risk classification. B. An objective risk classification. C. A hazard. D. A claim settlement option. Answer: B. An objective risk classification. Explanation: objective risk classification involves the use of measurable, quantifiable data to determine an individual's risk level, which is exactly what automated underwriting systems do. These systems assess risk based on objective factors like age, gender, health, and lifestyle, which can be measured without subjective judgment. A subjective risk classification would involve more qualitative assessments. A hazard refers to conditions that increase risk, and a claim settlement option refers to how the benefits of a policy are paid out, neither of which is the focus in the underwriting process described here. Question 7. In an insurance policy, the incontestability clause typically ensures that A. The insurer cannot cancel the policy for non-payment after the policyholder has passed away. B. The insurer can contest claims for misrepresentation of facts for up to 2 years. C. The insurer cannot deny a claim for a covered event after the policy has been in force for 2 years. D. The insurer cannot file a claim for a non-covered event after the policy has been in force for 2 years. Answer: C. The insurer cannot deny a claim for a covered event after the policy has been in force for 2 years. Explanation: the incontestability clause in a life insurance policy typically prevents the insurer from denying a claim due to misrepresentation or fraud after the policy has been in force for 2 years. This provides the policyholder with protection against the insurer denying a claim for something the insured may have omitted or misrepresented. Applying for the policy, option A is incorrect because the incontestability clause does not address cancellation due to non-payment, and option B is incorrect because the clause limits the insurer's ability to contest claims, not the other way around. Option D is incorrect because the clause concerns the insurer's right to contest, not the policyholder's ability to file claims. Question 8. Which of the following is the primary purpose of the law of large numbers in insurance? A. To reduce the premium rate for high-risk policyholders. B. To estimate the future payouts of claims more accurately. C. To assess the financial strength of an insurance company. D. To increase the risk exposure for insurers. Answer: B. To estimate the future payouts of claims more accurately. Explanation: the law of large numbers is a fundamental principle in insurance that states that as the number of insured individuals increases, the actual losses will tend to be more predictable and closer to the expected losses. By having a large pool of policyholders, insurers can better estimate future claims payouts, which helps them to set premiums accurately and manage risks. Options A, C, and D are incorrect because the law of large numbers does not directly deal with risk reduction, assessing financial strength, or increasing risk exposure. Question 9. Which of the following is an example of moral hazard in insurance? A. A driver who installs an anti-theft device in their car to lower the risk of theft. B. A policyholder who takes more risks because they have insurance coverage. C. A homebuyer who chooses a higher deductible to save on premiums. D. A homeowner who maintains fire alarms and extinguishers to prevent loss. Answer: B. A policyholder who takes more risks because they have insurance coverage. Explanation: moral hazard refers to a situation where the insured party takes on higher risks because they know they are covered by insurance. This behavior occurs because the policyholder may not bear the full cost of their actions, leading them to be less cautious. For example, someone might drive recklessly knowing that their insurance will cover the damages. Options A, C, and D are examples of risk management behaviors that reduce the likelihood of loss, not increase it, and therefore do not represent moral hazard. Question 10. Which of the following underwriting factors is most directly related to the financial stability of an applicant? A. Age. B. Occupation. C. Credit history. D. Health status. Answer: C. Credit history. Explanation: credit history is often used as an underwriting factor because it provides insight into the financial responsibility and stability of the applicant. A poor credit history may indicate a higher likelihood of financial instability, which could affect the applicant's ability to make premium payments or manage their finances effectively. While age, occupation, and health status are important factors in risk classification, are not directly related to financial stability in the same way that credit history is. Question 11. Which of the following underwriting practices helps prevent adverse selection in an insurance company? A. Issuing policies without underwriting review. B. Using risk classification systems based on actuarial data. C. Offering policies with guaranteed issue terms. D. Allowing applicants to self-report their health status. Answer: B. Using risk classification systems based on actuarial data. Explanation: adverse selection occurs when high-risk individuals are more likely to purchase insurance, which can lead to financial losses for the insurer. To prevent this, insurers use risk classification systems, which categorize applicants based on factors like age, gender, health, and lifestyle. These systems help ensure that the premiums charged reflect the applicant level. Issuing policies without underwriting review, or offering policies with guaranteed issue terms, C, could increase the risk of adverse selection. Self-reporting, D, can lead to inaccurate risk assessments, further exacerbating the problem. Question 12. Which of the following is a characteristic of index life insurance? A. Premiums vary based on market performance. B. The cash value is tied to an equity index. C. It provides a fixed death benefit with no flexibility. D. It guarantees a minimum interest rate of 5%. Answer: B. The cash value is tied to an equity index. Explanation: index life insurance is a type of life insurance where the cash value is linked to the performance of a stock market index, such as the S&P 500. The policyholder's cash value grows based on the index's performance, but with floor to prevent losses, e.g. 0% growth. Option A is incorrect because the premiums are fixed in indexed life policies, not variable. Option C is incorrect because indexed life insurance is designed to offer flexibility. Option D is incorrect because the guaranteed minimum rate can vary depending on the policy terms. Question 13. Under the Nevada state law, which of the following actions by an insurance agent is considered an unfair trade practice? A. Recommending a policy based on a client's needs. B. Accepting compensation from an insurer for recommending policy. C. Offering policy with premiums based on market conditions. D. Discriminating against policyholder based on gender or age. Answer: D. Discriminating against a policyholder based on gender or age. Explanation: under Nevada state law, discrimination based on gender, age, or other protected categories is prohibited in insurance underwriting. Such practices are considered unfair trade practices and are subject to regulatory action. Options A, B, and C are not unfair trade practices as long as the agent is acting within the bounds of legal guidelines and regulatory standards. Question 14. Which of the following is a benefit of using an automated underwriting system? A. It guarantees the issuance of the insurance policy. B. It eliminates the need for human intervention and underwriting. C. It reduces the time and cost associated with underwriting decisions. D. It ensures that every applicant qualifies for the same premium rates. Answer: C. It reduces the time and cost associated with underwriting decisions. Explanation: automated underwriting systems streamline the underwriting process by using data inputs such as health, age, and lifestyle factors to assess an applicant's risk. This reduces the time and administrative costs involved in underwriting decisions. However, it does not guarantee policy issuance. They eliminate human involvement entirely. B. Or result in uniform premium rates for all applicants. D. As premiums still vary based on individual risk assessments. Question 15. Which of the following riders allows a life insurance policyholder to increase their coverage without undergoing additional medical underwriting? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Waiver of premium rider. D. Cost of living adjustment rider. Answer: B. Guaranteed insurability rider. Explanation: A guaranteed insurability rider allows the policyholder to increase their coverage at certain intervals, e.g. every 3 years, without undergoing additional medical underwriting. This rider is beneficial when the policyholder's needs for life insurance coverage increase but they do not want to undergo further health assessments. Other riders like accidental death benefit, waiver of premium, and cost of living adjustment do not provide the same flexibility regarding increasing coverage without medical underwriting. Question 16. In property insurance, which of the following scenarios would most likely result in the insurer invoking a coinsurance clause? A. The policyholder's property is destroyed by fire that exceeds the coverage amount. B. The policyholder underinsures their property by a significant amount. C. The property's value has increased over time, but no adjustments are made to the policy limits. D. The property has been abandoned and the insurer is unable to locate the policyholder. Answer. B. The policyholder underinsures their property by a significant amount. Explanation. The coinsurance clause in property insurance typically applies when the insured fails to insure the property to a certain percentage of its value, often 80%, 90%, or 100%. If the property is underinsured, the insurer will apply the coinsurance penalty, reducing the payout proportionally to the amount the property was underinsured. Scenarios may lead to other issues, e.g. underinsurance penalties, abandoned property, but they are not directly related to the coinsurance clause. Question 17. Which of the following best describes a moral hazard in insurance? A. A policyholder's tendency to take more risks because they know they are insured. B. The likelihood of an insured event occurring based on objective data. C. The impact of an increase in premiums on the policyholder's behavior. D. The probability of loss based on policyholder's financial standing. Answer A. A policyholder's tendency to take more risks because they know they are insured. Explanation. Moral hazard arises when individuals or entities engage in riskier behavior because they are insulated from the consequences due to insurance coverage. In other words, the knowledge that they are protected from financial loss leads to more risky actions. Option B refers to an objective risk assessment, not moral hazard. Option C describes potential behavioral response, but it is not moral hazard. Option D is more related to underwriting assessments rather than moral hazard. Question 18. Which of the following provisions allows a policyholder to reinstate a lapsed life insurance policy? A. Grace period provision. B. Reinstatement provision. C. Non-forfeiture provision. D. Dividend option. Answer. B. Reinstatement provision. Explanation. The reinstatement provision allows a policyholder to reinstate a lapsed life insurance policy, typically within a specified period, often 3 years, provided the policyholder meets certain requirements, e.g. payment of back premiums and proof of insurability. The grace period provision A provides a short period to make a late payment before the policy lapses. Non-forfeiture C deal with alternatives to policy cancellation, such as reduced paid-up insurance. Dividend options D refer to ways in which the insurer may return policyholder dividends. Question 19. What is the primary purpose of using mortality and morbidity tables in underwriting? A. To determine the appropriate amount of coverage for the policyholder. B. To predict the likelihood of future claims and determine premiums. C. To assess the legal risks associated with underwriting an insurance policy. D. To ensure the policyholder meets the underwriting criteria. Answer. B. To predict the likelihood of future claims and determine premiums. Explanation. Mortality and morbidity tables are used to estimate the likelihood of death or disability occurring in a given population based on age, sex, and other factors. This helps insurers predict the probability of claims and set premiums accordingly. These tables do not determine coverage amounts, A. Legal risks, C. Or whether the applicant qualified. Underwriting, D. Though they are integral in calculating the insurer's overall risk exposure. Question 20. Which of the following is an example of risk avoidance in the context of risk management? A. Purchasing insurance to cover potential losses. B. Installing a security system to reduce the risk of theft. C. Deciding not to engage in a dangerous activity to avoid the risk. D. Sharing the financial burden of a potential loss with another party. Answer. C. Deciding not to engage in a dangerous activity to avoid the risk. Explanation. Risk avoidance is a strategy where the individual or organization takes steps to eliminate or avoid risk altogether. For example, choosing not to engage in a dangerous activity as a way to avoid the risk entirely. purchasing insurance. A. Installing security systems. B. Sharing risk. D. Are all forms of risk management, but they eliminate the risk. They simply help mitigate or manage it. Question 21. Which of the following actions is typically considered an unfair trade practice under Nevada insurance law? A. Insurer providing a discount to a policyholder for having a clean driving record. B. Insurer refusing to issue a policy based on the applicant's health status. C. Agent making a misrepresentation about policy benefits to secure a sale. D. Insurer offering a policy with lower than market premiums. Answer: C. Agent making a misrepresentation about policy benefits to secure a sale. Explanation: misrepresentation of policy benefits is considered an unfair trade practice under insurance law. Agents must provide accurate and truthful information about the policy terms and benefits. Offering discounts based on driving records. A. Is standard in the industry. Refusing to issue a policy based on health status. B. Is permissible as long as it is consistent with the underwriting guidelines and not discriminatory. Offering lower than market premiums. D. Is not inherently illegal unless it violates pricing laws or involves fraud. Question 22. Which of the following is true regarding an insurance policies? Incontestability clause. A. It protects the insurer from fraudulent claims made within the first year. B. It prevents the insurer from denying a claim based on misstatements after 2 years. C. It allows the insurer to void a policy after 3 years if the insured is still alive. D. It guarantees that the insurer will always pay the full claim amount. Answer: B. It prevents the insurer from denying a claim based on misstatements after 2 years. Explanation: the incontestability clause in a life insurance policy stipulates that after a specified period, usually 2 years, the insurer cannot void the policy or deny a claim due to misstatements made by the policyholder except in cases of fraud. This protects policyholders from losing coverage after a certain period. Option A is incorrect because fraudulent claims are typically excluded from this protection. Option C is incorrect because the clause prevents policy cancellations after 2 years, not after 3. Option D is incorrect because the clause doesn't guarantee payment of the full claim amount but rather protects the policy from contestation. Question 23. What is the key difference between a standard and a substandard risk classification? A. Standard risks have higher premiums due to their better health conditions. B. Substandard risks are rated with higher premiums due to higher risk of loss. C. Substandard risks are not eligible for coverage under most policies. D. Standard risks are only offered life insurance policies. Answer: B. Substandard risks are rated with higher premiums due to higher risk of loss. Explanation: a substandard risk classification applies to applicants who are considered to have a higher than average risk of death or loss due to factors such as poor health or hazardous occupations. These individuals are often rated with higher premiums to compensate for the increased risk. Standard risks are those who fall within typical risk parameters and are charged no premiums. Option A is incorrect because standard risks have lower premiums. Option C is incorrect because substandard risks can still be covered but with adjusted premiums. Option D is incorrect because standard risks can be offered various types of insurance, not just life insurance. Question 24. Which of the following is a function of the underwriting process in insurance? A. Calculating the insured's premium based on their risk profile. B. Issuing policies to all applicants regardless of risk. C. Determining the beneficiaries of the insurance policy. D. Managing claims once the policyholder files for a loss. Answer A. Calculating the insured's premium based on their risk profile. Explanation: underwriting is the process in which an insurer evaluates the risks associated with an applicant and determines the appropriate premium for coverage. The underwriting process considers factors such as age, health, occupation, and lifestyle to assess risk and establish premium rates. Options B, C, and D are not the primary roles of underwriting. Policy issuance and beneficiary determination are handled at different stages of the policy process, while claims management is the responsibility of the claims department. Question 25. Which of the following types of life insurance policies offers flexible premium payments and allows the policyholder to adjust the death benefit? A. Universal life insurance. B. Term life insurance. C. Whole life insurance. D. Endowment life insurance. Answer A. Universal life insurance. Explanation: Universal life insurance is a flexible premium adjustable life insurance policy that allows policyholders to alter their premium payments and death benefits within certain limits. It combines life coverage with an investment component that earns interest. Term life insurance B offers fixed premiums for a set period but no cash value or flexibility. Whole life insurance C fixed premiums and a guaranteed death benefit with no flexibility to adjust the coverage. Endowment life insurance D provides a lump sum benefit if the insured survives to a certain age, but it is not as flexible as universal life insurance. Question 26. Which of the following is an example of risk pooling in insurance? A single individual purchasing a policy with a low deductible. B. A group of people contributing to a common fund to cover potential losses. C. An insurer investing premiums in bonds and stocks to increase profit. D. An individual purchasing multiple insurance policies to cover different types of risks. Answer. B. A group of people contributing to a common fund to cover potential losses. Explanation. Risk pooling occurs when a group of individuals or entities come together to share the financial risk of loss. The premiums of the group members are pooled together to provide funds for claims. This is the foundational concept of insurance, where risk is spread among multiple parties to reduce the financial burden on any single individual. Option A refers to individual policy choices, not pooling. Option C refers to investment activities, and option D involves diversification rather than pooling risks. Question 27. What is the primary purpose of an exclusion in an insurance policy? A. To provide coverage for additional risks not covered under the standard terms. B. To limit the insurer's liability by excluding certain risks or circumstances. C. To increase the premium rate for certain high-risk activities. D. To specify the exact amount the insurer will pay for each claim. Answer. B. To limit the insurer's liability by excluding certain risks or circumstances. Explanation. Exclusions are provisions in an insurance policy that outline specific situations, events, or conditions that are not covered under the policy. This helps limit the insurer's liability and ensures that coverage applies only to the risks intended. Option A is incorrect because exclusions do not provide additional coverage. Option C is incorrect because exclusions reduce coverage, not increase premiums. Option D refers to policy limits, not exclusions. Question 28. Which of the following is a characteristic of a fixed annuity? A. The payments vary based on market performance. B. The insurance company assumes the investment risk. C. The payments are based on the performance of the stock index. D. The annuity's value can decrease if the market performs poorly. Answer. B. The insurance company assumes the investment risk. Explanation. A fixed annuity guarantees the policyholder a fixed stream of income for a set period or for life, with payments that do not fluctuate based on market conditions. The insurance company assumes the investment risk in this type of annuity. Option A and C describe characteristics of variable or indexed annuities where the payments depend on market performance. Option D is incorrect because fixed annuities provide a guaranteed return regardless of market conditions. Question 29. What is the purpose of a waiver of premium rider in a life insurance policy? A. To reduce the premium amount if the policyholder becomes ill. B. To allow the policyholder to skip premium payments if they become disabled. C. To increase the death benefit in the event of a policyholder's disability. D. To convert the life insurance policy into whole life policy. Answer. B. To allow the policyholder to skip premium payments if they become disabled. Explanation. A waiver of premium rider allows the policyholder to stop paying premiums if they become totally disabled while keeping the policy in force. The policyholder is not required to pay premiums during the disability period, and the insurer waives these payments. Option A is incorrect because the rider does not reduce the premium amount, it waives it. Option C is incorrect because it does not automatically increase the death benefit. Option D is incorrect because the rider does not convert the policy type. Question 30. Which of the following best describes the cost of insurance in a life insurance policy? A. The portion of the premium that is used to cover administrative costs. B. The amount paid by the policyholder to the insurer for premiums. C. The amount deducted from the cash value to cover the insurance protection. D. The portion of the premium that is invested to generate interest. Answer. C. The amount deducted from the cash value to cover the insurance protection. Explanation: the cost of insurance (COI) is the amount deducted from the cash value of a permanent life insurance policy such as whole life or universal life to cover the insurance protection. This includes the cost of mortality risk and other insurance-related costs. Option A refers to administrative costs which are separate from the cost of insurance. Option B refers to premiums, but not specifically the cost of insurance. Option D refers to the portion of premiums allocated for investment which is separate from the COI.